Okay, students, welcome to Chapter 1, our last chapter, ironically, but congratulations on the good job on Exam 3. I thought that was actually going to be a pretty tough exam, and y'all did great on it. So I am very proud of y'all, very proud of what you're accomplishing, and just keep going. That's the way accountants have to be. You have to persevere in the face of difficulties. Um, and that's the way your careers are going to be. So this is preparing you for your career, and I hope it's preparing you well. Um, we go back to chapter 1 because I think it's important to periodically look back and remember kind of the basis for how all accounting decisions are made. And that's laid out in chapter 1. Now, the first part of chapter 1, about the first half of it, is a little bit of a history lesson. And a lot of you may be thinking, well, I don't like history. My answer to that is, well, then why are you becoming an accountant? And you may say, what? Well, the answer is, as accountants, we're historians. Stop and think about it. What does a historian do? They report about what has happened in the past. And that's what we as accountants do. We do not try to predict the future. We do not have a crystal ball that tells us what's going to happen. We just report what has happened in the past. And so we are historians. In fact, the oldest written records in existence are accounting records, actually. And so we're just continuing a long tradition of reporting what has happened. Now, chapter 1, we come down here, and this is an important statement here. We've been focused on financial accounting in this course. This is part of the financial accounting sequence. And so the primary focus of financial accounting is basically to provide financial statements. The focus is on of financial accounting is on the information needs of investors and creditors, and that's through the financial statements and the related disclosures. And up here they think about accounting as a special language. Accounting is often referred to as the language of business. Okay, so let's move on down. Right here you see kind of an interesting reality. In business, hopefully businesses make good decisions. Well, how do they make good decisions? Well, they get useful information, and that comes from good accounting judgments. There are shades of gray. We have to navigate those and make good judgments. Sometimes there's no clear-cut answer, and that's when you need to go back to these concepts that are spelled out in chapter 1 and think, what would be the right thing to do theoretically? What would be good, sound accounting theory? So remember, I told you all the first day, the purpose of accounting is to provide information that's useful for decision making. So you need to always go back and make sure you're doing that. Okay, we move on down. And here they talk about the primary means of conveying financial information to investors, creditors, and other external users is through financial statements and related disclosures. And they mention the financial statements, the balance sheet, the income statement, statement of cash flows, and what's required is a statement of retained earnings, but usually what's provided is a statement of stockholders' equity. And the statement of retained earnings reconciles a beginning and ending balance of retained earnings. Statement of stockholders' equity reconciles a beginning and ending balance of all stockholders' equity accounts, including retained earnings. Balance sheet, sometimes called the statement of financial position. The income statement is sometimes called the statement of operations, sometimes called the profit and loss statement. So Anyway, let's move on down. They get into the discussion about capital markets, and the job of capital markets is to allocate resources. And resources are allocated largely through the capital markets based on accounting information. So when we provide financial information, we are actually keeping the American economy going by making sure that the allocation of resources is good and sound. So let's move on down. They get into investment and credit decisions, and again, those are usually based on accounting information. Right here, they talk about the expected rate of return and the uncertainty or risk of that return are key variables in the investment decision. And where do investors look to make decisions about those things? They look to the financial statements. A company will be able to provide a positive return to investors and creditors only if it can generate a profit from selling its products and services. That's just the reality of it. And the objective of financial accounting is to provide investors and creditors with useful information for decision making. See that over here too. Now, what information is useful? Well, information that helps investors and creditors evaluate the amounts, timing, and uncertainty or risk associated with the enterprise's future cash flows. Okay, they talk about cash basis accounting, which you should understand now and should understand that generally speaking, GAAP does not allow it. Now, tax accounting does. Individuals are usually cash basis taxpayers, but cash basis records can be easily manipulated by paying cash near the end of the year to reduce net income or asking for advance payment to increase net income. Okay, accrual-based accounting is what is practiced in the United States, what's required by GAAP. And so net income is the difference between revenue and expenses. And revenue and expenses, revenue is recognized when products or services are delivered to customers and we have fulfilled our performance obligations. And expenses are recognized to match with revenues or for expenses that don't directly relate to generation of revenues to the time period when they occur, not when they're paid. Net income is considered a better indicator of future operating cash flows than is current net operating cash flow, again, because that can be manipulated. Down here, they get into a discussion of generally accepted accounting principles. Of course, we refer to that as GAAP, G-A-A-P, but pronounced GAAP. That's what we have been studying all semester, what you will continue studying in the fall in Intermediate 2. Now, they get into some historical perspective. The 1933 Securities Act and the 1934 Securities Exchange Act are really very important acts in the history of American business. The 33 Act set out the accounting and disclosure requirements for initial offerings in the stock market, and the 1934 Act created the SEC and set up regulation of business more carefully. Congress gave the SEC the authority to set accounting and reporting standards for companies whose stocks are publicly traded on any U.S. active exchange. The SEC has then delegated that task to the accounting profession in the private sector. And so that is where the Financial Accounting Standards Board, or FASB, gets its authorization, is from the power being delegated from the SEC. Apart from that, the FASB would have no real power. They talk about here, if the SEC doesn't agree with a particular standard issued by the private sector, it can force a change in the standard. In fact, it has done so in the past. Statement of Financial Accounting Standards number 19, dealing with the oil and gas industry, is one specific example. I think the one they're talking about here, if you come down to the footnote 11, but anyway, long history there. If you take my petroleum accounting class, I'll explain about that in more detail. But there were two methods of accounting for oil and gas exploration activities: the full cost method and the successful efforts method. Congress told the SEC to study them and choose one, and require everybody to use one. The SEC told the FASB to study it, choose one, and require one. The FASB did what they were told. They studied it. They came out with FAS 19, which required successful efforts. Well, that took a couple of years, and by then the political winds had changed, and Congress said to the SEC, how dare you disallow full cost because of lobbying efforts that full cost companies were making in Congress. Even though Congress had said choose one and require it, the SEC then went and said, how dare you outlaw full cost? And they ruled that companies that reported to the SEC didn't have to follow FAS 19. So that's a little bit of history. I get into the early standard setting. First standard setting body was actually what was commonly referred to as the CAP, Committee on Accounting Procedure. It was active from 1938 to 1951. They produced what were called Accounting Research Bulletins, or more commonly ARBs. They issued 51 of those. The last one actually summarized the others. And they got into a disagreement with the SEC. They lost, and they went away. And the APB, or Accounting Principles Board, was formed. The APB issued opinions, APB opinions, or APBOs. They were in existence from 1959 to 1973. They got into a disagreement with the SEC, and they went away. Now, the APB had a lot of problems. One was that members of the APB served on a voluntary basis. They kept their permanent jobs, and so they really weren't independent. They tended to represent their employers. They were a large body. I think there were 27, maybe something like that, members of the APB. And so it was large, unwieldy. They had a hard time ever agreeing on anything. And so they went away. They only issued 31 opinions over a period of about 14 years. So not real productive group. Well, the APB went away, and in July 1st of 1973, the FASB was born. Financial Accounting Standards Board. They are still in existence. Even though they have disagreed with the SEC, they have survived. There are 7 members. They are full-time employees. They get paid well. They have to sever all their ties with their previous organizations. And so they initially issued statements of financial accounting standards. Now they issue accounting series updates, or accounting standards updates, excuse me. And that's part of the codified GAAP that we'll get to on the next video. Now, a part of the FASB is the Emerging Issues Task Force. They address hot button issues and mainly specifically just get into nitty-gritty details about here's how you should report things until the FASB can deal with it. Okay, my time's about up. I'll stop there and we'll pick up with the next video.